Hey, welcome back, everyone. It is time for another red hot covered call video. Well, hey, look, we're back behind the mic, fired up because we're talking about the poor man's covered call. Now, look, I'm not going to bore you with all the spinning plate of the poor man's covered call and how it works. Okay, if you want to learn how the poor man's covered call trade works, you can go to YouTube and search, how do you do a poor man's covered call? But I think if you stick around in this video, you're going to learn how all the spinning plates work, and you're going to understand exactly how to determine your cost basis, your profit, and what happens if somebody takes your shares. Shares you don't have. This is one of the biggest questions most people have with the poor man's covered call. We're going to talk about it right here because I bring you timely and relevant covered call trades that I do, right? I don't talk about other people's trades. I talk about mine because I can speak to them. They're timely, they're relevant, and quite frankly, I can speak to it because I do so many of them. So we're going to talk about that, and I'm going to give you a poor man's covered call trade idea. Yeah, that's right. I'm not only going to talk about a current poor man's covered call trade I'm in right now, I just bought a leap option on a stock that I'm going to do a poor man's covered call this week. I'm going to give you that stock, let you begin your research, and maybe you'll do it too. Hey, look, let's go ahead and get to this. There is a lot to talk about. Look, if you've never been to my channel and you want to learn how to create retirement income, right? You're in retirement. You want to be in retirement. I teach people how to create retirement income. That's what I do. Okay? I want you to subscribe to the channel. It's right there. It's free. I come back every week, show you timely and relevant real trades that I do. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what I'm doing is this. I'm showing you that retirement income. Over the past 5 years, I've been able to generate $371,000 using the strategy of covered call writing and cash secure put selling. If you're someone that needs to generate income in retirement, you can't work, you don't want to work, covered call writing is my go-to part-time job for you in retirement. Absolutely love how I could generate some $6,000 in October, $7,500 in September. I'll tell you what, we can use the selling premium strategy to put real money on the table. So what I want you to do is learn this strategy. Now, a lot of you know I have a membership, and I love sending emails to my members about what interests me. I call it seeing the world through my eyes. Back in July, UPS had earnings, and they absolutely got destroyed. Stock was down some 20 points. I decided to enter a poor man's covered call trade with UPS. Now, if you're taking notes, right, you have a pencil, you want to take some notes. Golden rule number one when we're going to enter a poor man's covered call trade is buying your leap option when the stock is down tremendously. We absolutely want to buy our leap option when the stock is getting crushed because all of that call premium has been sucked out of the stock, right? The stock is plummeting because of earnings. We can get the 80 Delta leaps much cheaper. In fact, this UPS leap that I bought was some $12 higher a couple days before. Now, I ended up buying this leap option at $47.50, and I decided to start a covered call with UPS. Now let's talk about golden rule number two. Remember, when you purchase your leap option, the true cost of the leap option is the time value portion of your option. Remember I told you I spent $47.50 for that 80 Delta leap? Well, I bought the 150 when the stock was trading at 190. So let's do some really basic math here. On the day UPS is getting crushed, the 150 80 Delta in the money leap is selling for $47.50. The stock is trading for $190. So let's do the math here. The intrinsic value of the option I paid $47.50 for is $40. You see how that works? Buy somebody's shares at $150. I paid $47.50 for the right to buy somebody's shares at $150. There is $40 of intrinsic value in that option I bought. If I exercise their shares at $150, I could sell the UPS shares at $190 and get the $40 back. Okay, money out, money in. But it's that $7.50 that is the true cost of this trade. So the question is, can I spin covered calls month after month after month and generate near-term 30-day 30 Delta premiums, right? Putting money in my pocket, cash printing machine. Well, here's the deal. If I can do that and UPS stays above 190, I'm in the clear. This is going to be beautiful, right? I paid $47.50 for my leap option. By the way, I bought the January 2023 $150. If the stock stays above 190, then that $40 of intrinsic value will always be there, right? There will always be $40 of intrinsic value in my option if the stock is at 190. Now the question is that time value, right? I got to pay that back before I could become profitable. As I write near-term covered calls, I'm actually chiseling away at the cost of this trade. Now, the real hope here is that the stock moves higher and my option that I paid $47.50 for grows. Because remember, it's deep in the money, so every $1 move of the stock, the idea is my option moves 80 cents. So, as UPS goes from 190 to 200, the stock has moved 10 points. In theory, my option has moved 8 points. I'm making money on the option, and I'm selling near-term covered calls. Now I'm going to show you exactly what I've done here since July. And I find myself in a bad spot because UPS has gone above my strike price and I have to make a decision. This is where we start to get into murky waters with the poor man's covered call, because I have to make a decision about buying back my current option, rolling it forward. But when I roll it forward, I'm going to be paying some $8 to do this. And does it make sense? So let's go ahead and talk about the trade, because my current situation with UPS, when the stock was trading at 182, I went ahead and did the 30 Delta 30-day covered call. It was the 195 strike, and I never thought I'd be challenged. Well, a couple things happened, and now I'm being challenged. This is what I wrote to the members. And by the way, this is what I do all the time. In fact, when I show you that new poor man's covered call idea, I sent this to the members like this: seeing the world through John's eyes. I'm talking to them about my current situation. I want to lay it out so you can read it and get a feel for where I'm at. And I love to break down the numbers in terms of the debt, the credits, what I might do, what I need to do, and ultimately what I think I'm going to do. Now, hey, things change all the time, so what I say here, I may or may not do, but this is how I lay it out for the members. And as you can see, my most recent covered call was the November 12th 195 strike. There's a couple things there that I probably should have taken note before I did the trade. Earnings looks to be around November 12th. And the X date for which UPS kicks down a hella dividend, it is happening around November 12th. So if this thing is above 195 and the option buyer, right, the guy who bought this 195 option, if he can make money, he's going to take my shares. That means I am going to be assigned. They will buy my shares for 195. Now, this is a poor man's covered call. I'm on margin. I don't have the shares. So there's a lot of spinning plates here. And this goes back to what I said at the beginning of the video. It's not buy a stock, write a covered call. There's a lot of spinning plates, but the real benefit to the poor man's covered call is that if I had bought the shares at 190, I would have spent $19,000 for 100 shares. In this case, I leveraged $4,750 to buy someone's share at 150. So I'm protected. I can buy somebody's shares at 150 and I can write near-term covered calls. Because here's the deal. If I did this naked, meaning I did not buy the option, the 80 Delta in the money option, I sold the 195 strike, UPS is now trading for 203. And to have the share, right, to have the shares for this person to take at expiration, I'd be paying current market value. So having that leap allows me to have the shares at 150. We're able to avoid a disaster. Now, with that said, UPS has now moved to 202. And it has 22 days left. And with this starting to enter the peak Christmas buying season, I see UPS probably heading to 210, 220. So we're in a spot here because that 195 strike that I sold, I only got $1.08 for it, and it's now trading for over $11. So for me to alleviate this obligation of somebody taking my UPS shares at 195, I'm going to have to pay $11. Now, I can do that and alleviate the obligation. Now I don't have to give anybody shares at 202. I can now sit back, reevaluate, and maybe start writing covered calls again. But here's the deal. That $8 that I'm adding to this trade adds to my cost basis. I make nothing above 195. This thing has moved to 202, 203. I lose all of that when I buy this back. So by adding this to my cost basis, you see where I'm at. I already have to pay back $7.50 if this goes well. Now I've added another $8. And if UPS has just been on a tear for the past 2 weeks and this thing peels back, I just find myself in many, many stressful situations. Now, because this is a pure premium play, and I'm going to be writing 30-day, 30 delta covered calls, and I'm going to be buying them back the week of expiration, I could manage this. But see, at this point, I'm bored with it. Because now, if I got to add $8 to this trade, my leap call option, remember the leap call option was trading for $47.50? It's now trading for $56. Well, I didn't make any of that money, right? Now, the leap option has moved to $56. I'm paying out $8 to get rid of this trade, and the leap option has moved. So really, for me, it becomes a situation where, do I want to continue using UPS? I would rather use something else. I'm disappointed because this thing has just rocketed higher. If I bought it back, I'm going to have to pay $8 back. That's going to add to my cost base. I've only been able to generate over $200. I've owned this stock for 3 months. So for me, this is very disappointing, but the stock did exactly what I thought it would do. It would go higher. I just thought I would be able to manage it. Remember I told you that company event? Well, that's when the administration came out and said that UPS and FedEx would be asked to help with all this port slowdown stuff. So the markets loved it. They moved the stock higher. Now, in this case, what happens if my shares are taken away? Because remember I told you there was an X date coming? What if I forgot about the X date and somebody comes in and wants my shares? Let's talk about this for a minute because this is a big question a lot of people have. Well, let's think about it. What's going to happen is this. Somebody's going to want your shares at $195. So your brokerage has to deliver those shares at $195 per share. So what they're going to do is this. They're going to see that you have this 150 leap. Now, let me put an asterisk. My broker lets me decide if I want to execute my leap option or let them use the leap option to provide the share. Your brokerage may see the two legs together and just execute the trade. Might want to ask them how you want them to handle your poor man's cover call trades. Now, what's going to happen is the brokerage is going to exercise your 150 leap, right? They're going to exercise the 150. They're going to immediately sell the shares, and they're going to get 203 for those shares and send that person shares at 203. Okay? You don't collect anything above 195. So with that said, one common question that people hit me up with is this. Hey, John, they're going to send me $19,500. I'm going to exercise my leap option at 150. Then the brokerage is going to exercise and give them the shares at 195. Isn't there a bit of profit in there for me? Well, no, because the brokerage has to go out, sell the shares at 203. The call buyer gets that profit. Right? The call buyer is buying the right to buy it at 195. They're taking a chance. They're the gambler in this trade. So their trade went perfect. They bought the right to buy the shares off of you at 195. It's now trading at 203. They get that profit. So what are you left? You're left with $19,500 and all the call premium you were able to achieve when you held this leap to write covered calls. So if you don't have the money, then that's going to be a debit on your account with the brokerage. And you don't want to play with the brokerage. They're going to want their money 1 to 3 days. So if you're doing poor man's covered calls and you're leveraging more money than you can actually afford to pay back, better have a plan because your brokerage is going to exercise on you. They're going to take that 150 leap. They're going to buy the shares for the call buyer. You're left holding the debit. Did you make enough covered call credits to pay for that debit? Now, here's the deal. We don't want to go to expiration. This is what I always try to tell people. Look, this is a pure premium trade. We place the 30-day trade, but really it's a 25-day trade. Because what we want to do is manage it. We want to have control of it. Meaning, the last week of expiration, we're hoping the stock has not gone above your strike price. We can buy the option back cheaper and then we write another covered call. Remember, when we buy that leap, we're really looking to do multiple covered calls month over month. I've done 4 of them with this one leap. And this goes to the point where you want to use steady Eddie stocks. Stocks that go sideways to higher. You don't want to find yourself in spots where the stock rockets, because you're going to find yourself being assigned. You're going to find yourself where you're going to lose your leap. And then the whole goal of this poor man's covered call trade, to use that leap for multiple covered calls, well, now it's out of your hands, because the brokerage is going to assign. Now you're going to be left with a credit or debit, but now you got to go find another poor man's covered call trade. Now, in my email to the members, and by the way, 1 free month, you go over to my website, cptdashboard.com, you will get these messages, right? I don't just provide you all the tools, the dashboard, the spreadsheets, the videos. You have daily content for which I believe ups your game. I show you the world through my eyes. I've done thousands of trades. Absolutely love showing the members what I'm watching. Now, another thing you need to understand, everything about me is the next 30 days. I don't take victory laps when I pick a stock and the stock rockets. We don't do that. The only time I revisit a stock pick is if I can make money going forward. It's all about the next 30 days with John, because that's what we are going to use to generate income in retirement. Now, I did talk to my members about what I could do here and why I'm not going to roll it out and up. Okay, I even mentioned that I'd be adding some $9 to this trade. And to be honest with you, at the end of the day, I want to move on to another stock. So let me go ahead and show you that new stock. And real quick, before we get there, here's your UPS chart. I sold that 30-day 30 Delta strike. I wrote that covered call generating $1.80 when the stock was trading at 182.50. Never thinking it would test my 195 strike. Well, as you can see, it surely did, and now I'm in trouble. Now I have to make a decision. Luckily, I have made enough credits for which this trade can be profitable. But it's very important. We need to understand the poor man's covered call, understand all the spinning plates, and that's what I try to teach my members. So again, if you're interested, you want to learn this, you want to get poor man's covered call trade ideas, and of course you can ask me questions, right? You're a member, you have access, you can email me. Look, cptdashboard.com, click upgraded dashboard. It's less than $20 a month. Try it out. I'd love to give you that 1 free month. Now here's the star of the show. Here is the next poor man's covered call trade I'm going to do. Intel just had earnings, and just like Intel, they got crushed. And to be honest with you, this happens all the time. I am not surprised. In fact, I was waiting for this. Intel has fallen some 11% since they just reported earnings. And I'll tell you what, love that opportunity. This is one of those tech utility stocks. They pay such a large dividend, and they are a tech stock, but the reality is most wealth managers will put you in Intel for that dividend. So it trades sideways to higher. Now, Intel got hammered on earnings, and it meets my #1 golden rule of the poor man's covered call trade. Want to buy that leap on the day they're getting crushed. Now, the idea is simple with Intel. Right now, it's trading at about 49.37. So I looked at the 80 Delta January 2023 in the money strike, which is the 40 strike. Okay, that 40 strike will cost me $11.30. So let's do the math on this. If I bought this option, this leap option, to start writing poor man's covered calls, the option would have $9.35 of intrinsic value in the option, right? I pay $11.35. $9.35 is intrinsic value. That's real money in the option. It has $2 of time value. So $2 is my true cost. The question is, can I make that back? Can I make $2 back writing near-term 30-day covered calls with Intel, hoping Intel stays at 39.37? I believe I can, because if you look at the 30-day 30 Delta trades, you'll be picking up like 40 to 50 cents. So for me, I can actually spin this out a couple months. But I also think because we're buying it at the bottom, we're picking this up as Intel gets crushed. Intel could actually move higher. And that's what I think is going to happen. I think it moves back to 55 over time, just like it has every other time after earnings. So buying the leap here at 49.35, I do expect the stock to fall a little bit, but I got to get in the game. I got to get that leap option now, because that call juice is just poured out of that option. So today's the day for me to get 11.35 for that option. And that's what I did. I went ahead and bought that leap option. And as you can see with the chart here, Intel is that sideways to higher trading stock. We can write those 30-day, 30 delta strikes, just picking up little crumbs, right? We pick up little crumbs here, little crumbs there. Think of my investment. My investment is $1,135, right? So I can make that back over a course of time. And look, we got till January 2023. So if this works out for me, I'm going to be able to generate monthly income with a great S&P type company, a company that always does this, right? Every time they announce earnings, it falls, and then it rallies back, and it trades sideways to higher until the next earnings. So that would give us 3 months of trading. We see what happens during earnings, and then we get back on the horse and do it again. Intel is one that I'm going to be using. Now, I own Intel, so I took this opportunity to sell 5 contracts on a cash secure put. I ended up picking up $1.32 per share. I did an at the money 49. So I've got real skin in the game with Intel with a 30-day cash secure put, picked up $1.32 on 49 invested. And I bought this leap option for which we're going to turn right around and sell a 30-day, 30 delta covered call. Now look, my members get this kind of stuff all the time. 1 free month offer for you. Go get it. 1 free month. Say it with me. 1 free month. CPTdashboard.com. Click upgraded dashboard. Get your 1 free month. Hey, look, I'm going to leave it there. If you have any poor man's covered calls idea, post them in the comments below. Always love checking out the stocks you cats post below. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.